As the investor population ages, income from their investment portfolios becomes more and more important to their long-term investment outlook. REITs have played an increasing role in the income investor's investment profile. REITs have had the effect for most investors of delivering high current return. The average REIT preferred yields about 8%. The average common stock yields about 3.5%. We pay out about 5% in our fund family. REITs have been able to pay out high current income as well as, over the very long term, grow their dividends at or ahead of the rate of inflation. So as income becomes more and more important to individual investors in the United States, we believe that real estate investment trusts will continue to grow in importance. REITs were able to raise over $30 billion in equity beginning in 2009 to replenish the cash positions on their balance sheet and to effectively make them better borrowers and allow them to have access to the debt markets. REITs then were one of the first borrowers to emerge from the financial crisis in 2009 to be able to renew their existing maturities as well as issue both new secured and unsecured debt, as well as issue preferreds, which REITs use as a form of borrowing in the public market. So I would say that more so than anything else, the availability of debt to the REIT capital markets has probably been the most important event that we've seen, both negatively and then now positively. We believe there will be a competitive threat to REITs before long among the better capitalized private borrowers and investors, as well as direct investment on the part of both U.S. as well as international institutional investors. So REITs should not sit on their laurels at this point. The fact is that they enjoy a distinct advantage over their private market counterparts today, especially with their ability to both source equity and debt, and they should be taking advantage of it and making acquisitions and undertaking development where it makes the most sense for their shareholders. If they wait too long, or if they're too patient before they make their next investment or their new development, they do run the risk of their competitors in the private market, who are still suffering the pains of this last pullback, recovering and becoming more competitive. Going forward, in terms of REIT operations and challenges that they see to growth, both in the U.S. and also internationally, we believe REITs should first and foremost focus on existing property management and operations and cost controls to manage the existing portfolio. Secondly, in the promotion of their assets to customers and residents and tenants, that REITs should always be thinking strategically about how they best position their properties that are available for lease so that they can attract the best tenants as well as obtain the highest rents. And then thirdly, the constant and consistent focus on external growth, acquiring and developing new assets, portfolio acquisitions, as well as merger and acquisition opportunities. REITs really do need to be on their toes from a competitive standpoint and from a growth standpoint in order to properly maximize their value for their shareholders.